So good evening, everybody. Thank you so much for making it back after a heavy lunch. And I would like to thank all the council members for such warm words and such kind words. And I really am going to try my best to live up to all the hype that's been created. And I just request that after eating a very heavy meal, you guys have the energy and don't really, sleep it off through this session. And I'm going to make it my mission to make sure everybody is alive, awake, and kicking with me. Okay? So let's get started, guys. Firstly, before we get into any major discussion on quantitative investing or adaptive investing or investing in the new era of man with machine, let us take a small count of a simple example of HDFC Bank, Kotak Bank on the one hand, and some PSU banks on the other hand. And I think this example will create the base for everything else that we might want to discuss in today's session. So over the last 2 years, we've seen that Kotak Bank and HDFC Bank, for numerous reasons, haven't really performed well or given any significant returns to investors. On the other hand, we've also seen all the PSU banks have done very, very well and become, 2, 3, 4 baggers and re-rated and shown very, very strong growth as well, delivering significant returns to investors. So if we go back in time, say a couple of years, we might think that investing in the best managed companies, in high quality stocks, in high growth companies is the only way to make money. But what the last 2, 3 years have taught us is that even other types of stocks do well if the market environment changes, if the market scenarios change. So adaptive investing is the way to make sure that in some cycle, your portfolio owns HDFC Bank and Kotak Bank, and in another cycle, it is also open to own PSU banks, because the end goal of any asset manager or any investor is to actually make returns and benchmark beating returns across market cycles. So with that, let's get started and understand what does adaptive investing really mean. So I look at investing as a sport, and I break up all the sports in the world in 2 categories: single player, single dimensional sports, and multiplayer, multi-dimensional sports. So let's take a 100-meter race, for example. If Usain Bolt has to run and be the first player, he does not care how the others are running. He has to focus on his own sprint and make sure he's doing the best he can. That's a single dimensional sport. On the other hand, if we look at a football team or a cricket team, it's a multiplayer, multi-dimensional sport, which means every player on the field has to react and change their response based on the prevailing situations. For example, if let's take the example of our beloved Dhoni. I think every time India has been captained by him, he uses some tactics and techniques which make him stand out of the crowd. So let's take a few examples of what he's done. So in Indian cricket over the last, say, 15 years, we've seen multiple times under Dhoni's captaincy that the opening over will be bowled by a spinner, not a fast bowler. Or he will change the field setup completely. He will make sure that the 5-down batsman goes 3 down. All these decisions are showing a simple technique of what I call being responsive and being adaptive. Similarly, even in football, or when you go to see a football match, the field setup completely changes based on the situation of the game. If we are in the first 45 minutes, probably there will be more defense, more attack, and a lower midfield setup. But as the game progresses, the attack becomes more aggressive or the defense becomes more aggressive based on the total score of the game. So the point here is, in any field of life, whether we take sports, whether we take medicine, whether we take traveling, in everything, success only happens if you are adaptive. And I think a very popular saying is that you cannot control the direction of the wind, but what you can do is adjust your sails. So in investing also, we must try to follow principles that are keeping us unconstrained. So with that, let's get into what is so different about what we're trying to do here. So I think 2 things that all of us would agree on about the human species is that we are highly intelligent, but we are also very emotional. So what happens in investing is that the intelligence really, really helps us, But the emotions spoil the party quite a bit, multiple times. And if I just show you what goes on in a human brain or an investor's brain while looking at the prices and looking at the markets, the brain looks like this. This is a small snapshot of the amount of biases that play out in the human brain while making investment decisions. To give you some examples, the classic example is loss aversion. So what does loss aversion mean? Every time you have two stocks in your portfolio, one stock is up, say 50, 60%, and another stock is down 30%. And you have to create some cash because you need that cash for some reasons. You will always end up selling the stock which is 50, 60% up and never sell the stock which is 30, 40% down. And why would you do that? Because in your brain you've convinced yourself कि ये जब मेरे cost पे आएगा तब मैं ये stock से निकल जाऊंगा. तब तक I'm going to keep holding to that stock. Is that true or is that not true, guys? So this is one example of loss aversion. Let's take another example, or herd mentality. What does herd mentality tell us? That if 5 people around you are telling you to buy a stock, first 3 times they told you, you resisted it completely. And then you saw that stock did very well. But the 4th time they met you, you actually ended up buying the stock because everybody else was buying it and making money out of it, right? So this is, again, a bias that is hampering your investment decision making, your rational investment decision making. Another thing I would like to talk to you about is anchoring. Anchoring is something all of us go through on a day-to-day basis. And anchoring happens in markets on a day-to-day basis. It happens due to price fluctuations and M2M. So say today is day 1 of your markets, you're starting with 100 rupees. Your anchor is 100 rupees. But in the next 1 month, if that 100 becomes 200, then your mental anchor shifts from 100 to 200 because in your mind you already said कि 200 तो मेरा आ गया है. So now if 200 goes to 130, you will be very, very sad. You will not be happy that 100 became 130. You will be sad that 200 became 130. Why? Because your anchor has shifted from 100 to 200. Does all of you all also experience this on a regular basis of anchoring with profits, losses, share prices, etc.? If yes, then just raise your hands, guys. Exactly. Thank you. That's a thumping yes. So that's just a few examples of how all of us are fooled by the markets, by our own emotions. And a classic example during COVID that I think most of us went through, sunk cost. So we saw the markets correcting very aggressively. People who are investing for 5 years, at some point they realized that their 5 years of effort has gone to 0. So if you started with, say, 1 crore rupees before 5 years, you saw that becoming 1.5. At a certain point with all the meltdown in the markets, that 1.5 crore became 70 lakhs. That is when most of us decided to pull out the money of the markets, right? And everybody had started anchoring to the Nifty levels of 7,500. But what happened is, post that sharp correction, there was also a sharp rally. Now everybody decided one thing, that when I get to enter at or lower than the cost I exited is when I will enter the markets again. But most people never got the chance to enter the markets again because the rally was V-shaped rally, instant rally, right? So I think most of us also experienced things like this. So now with all of this, I think I've made one point very clear, that all of us are suffering very, very badly with a lot of biases. And it is best that we take an approach that helps us rise above these biases and move out of them. So the idea to break these biases is what I call quantitative investing. And it's a very, very simple process. It's like cooking with a recipe book in front of you. So there are 2 kinds of cooks in the world, right? One is a very, very seasoned guy who's got years of experience. If you tell him that, follow this recipe, he'll probably come and tell you, sorry, don't tell me a recipe. I know how to make every dish on my own. And then there is another guy like me who will say, okay, I don't think I'm the best chef in the world, but if I get a good recipe, I'm sure I can make it the exact same way. And all the QSRs in the world, right? The largest, the Domino's, McDonald's, Burger King, Pizza Hut, all of them, are they run on chefs who are star chefs, or are they run based on star recipes? Recipes, right? So even when we come to investing, would you trust a star chef to consistently cooking out star dishes for you? Or would you trust a star process that will make sure it'll keep dishing out star dishes for you? So I think the answer lies in processes. When we look at the largest global funds, or the largest global fashion houses, or the largest global food and beverage companies, everybody works on a process, everybody works on their secret sauce, and everybody uses a consistent method of creating the same output again and again. There are multiple players in the world who've tried to copy Coca-Cola. How many of them have been able to? Barely anybody, right? Pepsi's also tried. So many other global brands have tried. But Coke has something which is called their IP, intellectual property. It's the secret mix that they put inside water or soda, which makes sure Coca-Cola tastes the way it does. Now imagine in the world of investing, if somebody can create that IP, which then makes the multiple investment decisions, how sustainable and systematic the world of investing would get, right? That is what we're trying to do. So the way this works is, firstly, we start with inputs, every ingredient that we need in our strategy. We start collecting all the data. We start defining what do we want the strategy to do. Do we want it to beat Nifty? Do we want it to beat inflation? Do we want it to beat fixed deposit returns? Do we want it to be a 20% return strategy? Do we want it to be an absolute alpha strategy? There are multiple agendas we could start with when designing the strategy. So once we've collected all the inputs and all the data, we then decide how to process this data so that we keep getting a consistent output. And while processing, this is where all the magic happens. We have a team of close to 16 members today, from economists, macro analysts, Python programmers, financial engineers, risk analysts, fundamental analysts, technical analysts, FRMs, CMTs, and a host of other people. All of us are working together to create this secret sauce or this secret recipe. And we've been doing this for the last 5 years. And the idea is to blend all the different sciences of investing in one approach, which is only possible with the help of machines. I cannot individually process 1 lakh data points, be an expert of macros, be an expert of risk, be an expert of fundamentals, technicals. It's not possible. I can be broadly aware about all this and have a good enough understanding to be able to bring it together. But I need each and every star player in my team to come back with their inputs and help me build it all in one model, in one strategy. So this is the biggest advantage of taking a quantitative approach, where we are able to blend the diverse sciences. And we, in-house, we call this a quantamental approach. Quant plus fundamental plus technical, everything in one. And finally, once we've decided our rules, our indicators, our signals, our strategies, what we get is a simple, clear output that anybody can follow. What does the output tell us? What to buy, when to buy, how much to buy, and when to sell. All these answers come out of our strategy that we've designed in our software. Now, the final subject here is, once we've reached this stage, right, that we are getting the output from the models, do we stop and be like, okay, now I'll go to an island in Hawaii and I'll just chill, let the machine do all the work? It doesn't work like that. We continuously need to review, refine, improve the processes all the time, because the market is very, very dynamic and we continuously need to upgrade our systems as well. So that is just the basic of how quantitative investing works. It's not that complicated. There is some input, there is some complex processing, you get some simple outputs, and then you continuously refine your processes. Now, an important thing to know here is, me as the fund manager, my role is not to decide which stocks I want to buy, when I want to buy them. That is not my decision. That is decided by the strategy, by the models. My job is to define and design the strategy, the processes, the rules, the indicators. So if I want to change the output, I can't change the stocks. I have to change the process. That is how quant investing works, different from traditional investing. So far, everybody is with me? Perfect. Now, just to tell you where the world is heading. So this is a simple representation of, in America, right? 35% of all the assets are managed quantitatively. as opposed to India, where the number is less than 0.5%. If we go back 30 years, 78% of money was managed actively in America. That number is now in the 20% sort of range. Passive is close to 45, 50. Quant is close to 35. So active money management is globally losing market share to quantitative and passive money management. And I think we're seeing the same in India as well. We've started, but we're too early in this game, and the country is too early. So I think it's very, very important that people understand the importance of systematic investing, of unbiased investing, and of adaptive investing in the new age that we are in today. And globally also, if we look at, say, China, quant assets have grown 5x over the last 2 years alone. And US also is showing you similar numbers, that over 7 years, quantitative funds have grown at an 18% CAGR, as opposed to active funds, which have barely grown at a 1.8% CAGR. So whatever the data is suggesting, it's very simple, that the world is moving towards more sophisticated methods of investing, and India also cannot be left behind in this race. And this is a snippet of how India is looking, right? Since 2007, on a very, very minuscule sort of base, India has also grown its quantitative assets at 220x, as opposed to active assets or passive assets, which have grown significantly more in terms of size, but lower in terms of percentage. So this data is slightly skewed or biased because of the low base effect of quantitative assets in India. But the good thing to know is that this is also growing. Now, I think the common question is, why now? Why is this happening now? So the answer is very, very simple, guys. Today, the kind of access to data that we have in India, we didn't have it, say, 10, 15 years back. The kind of technology that is available, we didn't have it, say, 15 years back. And at the same time, the kind of talent that you need to mine this technology and combine principles of finance, investing, using technology, this kind of talent is becoming available now in India. This wasn't highly available, say, 15, 20 years back. So we are clearly in a new age and a new era of investing. So I think everybody is well acquainted with smartphones, smart TVs, smart cars, and smart homes. So when everything in the world is getting smart, why can't your investing get smart? So in PL, we've decided to make it our mission to only build, create, and offer smart investment strategies to all our investors through our PMSs. Every strategy is going to be smart. Now, how do we define what is smart, right? Smart can be defined in multiple ways, but in terms of investing, we have taken our own definition for defining what a smart investment philosophy looks like. So the first component of a smart investment strategy is that it must be designed systematically using a rules-based approach which eliminates all biases. That is the first pillar of smart, systematic design. The second pillar is the performance must be measurable and tested rigorously across market cycles. This cannot work on your emotions, intuition, experience, wisdom, gut, feeling, nothing. You have to be able to test it. And the way we summarize it, you can trust it only if you can test it. So if you're not able to test your strategy, you can't trust your strategy. So that is the second pillar. The third pillar is A. It stands for adaptive models. Adaptive models are those that can dynamically respond to the changing landscape of markets, of macros. Your models need to be adaptive. You can't have one size fits all in the world of investing. And the fourth thing is R, repeatable alpha. Repeatability is very, very important. And I think in the world with all these CAs in this forum, I will take an example of extraordinary items, right? Whenever we are doing any valuation exercise and looking at the balance sheet of companies, we remove the extraordinary items or extraordinary profits that a company has got in a certain year. We don't build it into our future projection, neither into our valuations. Why do we do that? Please somebody answer this question. Yes? Perfect. It's a one-time event. Then it is not sustainable. Perfect. So the idea is it's a one-time event. It's not sustainable. In essence, it is not repeatable in the future. If it is not repeatable, how much value can you place to it? So even in an investing strategy, when we talk about hero stocks, right? Bajaj Finance, another stock 100x, this stock 500x. How many people can find these stories time and again repeatably? How much of your portfolio will be allocated to these kind of stocks time and again? When will you decide to hold it? When will you decide to exit it? When will you decide to buy it? When will you decide to double your weight? Is this whole thing repeatable? When your portfolio returns are coming from 1 or 2 stocks alone, is that a repeatable process? Or 2022 of your portfolio stocks are not giving you multi-bagger returns, but are batting very, very strongly. Do you want Kohli to make 200 runs and Team India's score to be at 230? Or do you want all your 7-8 players to hit 30-40 runs and make sure India wins? We believe that repeatability comes from granularity. Granularity means we don't have few large winners, we have multiple small winners. So this is the 4th point. The last thing is transparent attribution. Because we use such a data-driven approach, a multi-factor approach, we exactly know why which stock is coming in, why which stock is going out, how much weight do I have in a certain sector, how much weight do I have in large cap, mid cap, small cap, and why is all this happening? It's transparent. The whole process is transparent. It is not on my gut and feel के मुझे लग रहा है अभी market थोड़ा top out हो गया है, थोड़ा अभी large cap में पैसा डाल दो. मुझे लग रहा है स्मॉल कैप अभी बहुत यूफोरिक जोन में है, स्मॉल कैप से निकल जाओ. मुझे लगता है अभी आईटी में बहुत वैल्यू आ गया है, आईटी में एलोकेशन बढ़ा दो. It doesn't work like that. It works based on a process. So all of this that I told you about comes together in one strategy which we call AQUA, and I'm going to tell you guys a little bit more about this. So AQUA is basically inspired by water. पानी का एक बहुत अच्छा property है. It has a very, very good characteristic. It can take any shape, any form, and any color. If you boil it, it will become steam. If you put it in the fridge, it will become ice cubes. It can take the color of turmeric, it will become yellow. If you put red chili, it will become red. If you do nothing, it will stay still. So water has very, very good properties. And we as investors need to embrace those properties and make sure our investment strategy also reflects that. So AQUA is basically telling you that like water, be adaptive. When we talk about color, shapes, and forms, in markets also we have similars, right? How we can be adaptive across our allocation to large, mid, and small caps. We can be adaptive across our allocation to different sectors. We can be adaptive across our allocation to different styles. Do you all know that there are multiple styles of investing in the market, and every fund manager and every human being comes with a predefined style bias? We'll talk a little bit more about that as we go along. So AQUA is basically telling you, be like water, be adaptive, take a quantitative approach, be unbiased, and focus on alpha. Focusing on alpha is the most important thing that all of us are here for. If we want Nifty returns, if we want FD returns, invest in a Nifty ETF, invest in an FD. We are not here for that. We are here, everybody seeking one thing over and above this. That's called alpha. Alpha means excess returns over and above the benchmark. So if Nifty is giving me 12%, can you give me 16, 17, 18%? Yes, then you can take my money, you can justify your fees. If Nifty is falling 30%, can you fall 20%? You will fall. Of course, you will fall because you are investing in the markets. But can you fall less than the Nifty? If yes, that is alpha. When the market rises, you can rise more. When the market falls, you can fall less. If you can do this long term across market cycles, you're basically in the business of not generating returns, but of generating alpha. And I am here only to design strategies that can generate significant alpha. And continuing with what we left last slide, I was talking about being adaptive. So AQUA is basically dynamic and flexible across multiple things, which I already explained to you all. In a certain cycle, even cash can be your best friend. Having cash in your portfolio helps you generate alpha. In a certain cycle, having a small and mid-cap orientation helps you generate alpha. In a certain cycle, having a high beta portfolio makes you generate alpha, and in a certain cycle, a low beta portfolio. But given there are so many things happening in the market and so many decisions to make, I don't think I'm competent enough with my emotional and mental wherewithal to keep doing this again and again and keep doing it right. But when I have been given an opportunity to spend 2 to 3 years to build one strategy, I can actually make sure everything that helps me make better decisions, I have taught my models so they don't falter. Even if I falter, they don't falter. Even if I fall sick and I'm not able to make a decision, I know my computer can make those decisions. And that is the whole advantage of training your computer to make investment decisions for you. And this is again going back to the big topic of the day, which is styles, investing styles, and how you need to be adaptive in today's day and age. This is, I've highlighted 5 different investing styles, compared it to the benchmark, which is Nifty, and show you a very, very simple thing. Forget the numbers, look at the colors. What do the colors tell you? Different styles do well in different market and macro conditions. In some phases of the market, you will see momentum is doing very well. In few other phases of the market, you will see growth is doing very well. In bear markets, quality and low volatility will do very well. In transition markets, value will do very well. So the point is, whenever we meet people or think to ourselves, I am a value investor, I am a quality investor, I am a growth investor, I think all of this is not up to the mark. It is not sophisticated enough. The only approach to be ahead of the markets is by being an adaptive investor. An adaptive investor is one who can behave like a value investor for 1 year, and another year behave like a growth investor, in a third year behave like a momentum investor. But I don't think for me or for anybody out there, it is possible to keep changing your styles as the market conditions change. So we leave that hard work, dirty work to the machines. We let them track 1 lakh data points and tell us which style to follow, rather than us taking that decision of which style to follow. So the idea again here is, don't treat style as an external thing. Style is a very internal thing. It's like your language. So if I were to go to Russia tomorrow and nobody speaks English there, I've been there actually, nobody speaks English there. So can I just start speaking in Russian language? I can't, because I don't know it. Similarly, my style, investing style, is as personal to me as my language. I can't change it. But what I did in Russia to survive those 8 days when I went there was use Google Translate. I type in English, it converts it to Russian, I show the message, and they respond back to me. And that's how I managed. So again, the approach here was man with machine. Man with machine approach helps you navigate complexities, and even in investing, a man with machine approach helps you navigate complexities. And this is again telling you that we've broken down the markets into 5 different phases. I think everybody is well aware, whoever's been active in the markets is fairly well aware. So accumulation, consolidation, contraction, distribution, participation. Participation is your classic bull market phase where everybody wants to jump in. What does well? Momentum, growth, small cap investing, which is size. This does well in the participation phase. Then the worst phase that everybody is scared of, contraction. What does well? Quality, low volatility. In the accumulation phase, what does well? Growth and momentum. And in the distribution phase, where everybody's seen a big rally and now gradual there is distribution over a period of time, what does well? Stocks which have a higher margin of safety. They fall less or they rise more. We call them value stocks. So I've established one point very clearly with data, that different styles work across different cycles, and we need a strategy to help us do this. So to finally summarize all of this, when there is a risk-on phase, everybody wants to invest in markets, everybody's saying, ghar bech ke market mein paisa lagao, we call that a risk-on phase. Growth and momentum investing does very well in this phase. Now there is a shifting risk phase. Inflation is going up, interest rates are going up, macros are looking weak. What does well? Value investing does well in this phase. And finally, when there is a risk-off phase, when there's uncertainty, there is an economic contraction, quality and low volatility styles of investing do well in this phase. So far, we've discovered that unlike traditional investing where value is the best approach or growth is the best approach, multiple styles do well across cycles, and we need to make sure we can navigate this. So AQUA, what AQUA really does is, it is agnostic to any one style. It is neither saying it likes value nor growth nor quality. It is agnostic. It doesn't anchor to any one thing. At the same time, it blends multiple styles, selecting a stock based on quality, growth, value, momentum, risk. All of these factors are combined. So it is agnostic to one, it blends multiple, and its final point about AQUA is it is adaptive, which means it gives you a style tilt. So in a certain cycle, say last year, my portfolio had a style tilt of value. In the COVID era, it had a tilt of quality. Post that, post-COVID recovery, we had a tilt of momentum. So in the last 3-4 years, we've seen the portfolio behave like 3-4 different fund managers. Quality fund manager for some time, a momentum fund manager for another time, a value fund manager post that. So this is the whole idea that you have to be agnostic to style, to size, to sector, and to the benchmark. Being agnostic to the benchmark is very, very critical to generate alpha. I think let's talk about this in a little more detail, guys. So, Nifty 50 or say Nifty 500, that's a classical benchmark that most of us follow, right? That's a gauge of how the market is doing. The Nifty is comprised of a certain things. It basically tells you that, okay, financials have 30%, Reliance has 10%, TCS has, or Infosys has 4%, IT as a sector has 12%. Like that, multiple sectors and stocks have weights. When you invest in traditional ETFs or index funds or even most large cap oriented funds, what we see is that they are anchored to the benchmark and they hug the benchmark to a huge extent. To give you an example, if a traditional fund had to take a call on IT as a sector in the bear market for the last, say, 1.5 years that IT saw, they would first say, okay, benchmark me, there's a 12% weight to IT. Let me be underweight. Let me make my weight 9%. So I'm underweight, but I'm not going 0. I'm going to 9%. Similarly, if I was overweight on financials, I will say, okay, benchmark me, there's 30. Let me go to 33. Let me go to 34 to show that I'm overweight on this sector. This is not a sustainable approach to generate huge alpha. This will always move in line with the benchmark, plus minus few basis points. What we do is instead take a completely benchmark agnostic approach. Say for the last 1.5 years, on an average, industrials, that whole sector, which comprises of cap goods, defense, engineering, some infra companies, that whole segment has a weight of between 40 to 50% in our portfolios, as opposed to benchmark weight of 8%. So this is a benchmark agnostic allocation. For the last, say, leaving the last quarter aside, I think for bulk of the 1.5 year period, our weight to IT was near 0. When the weight to IT is near 0, we are showing high levels of conviction that we don't think alpha can be made from IT. So I will not buy IT stocks just because it's there in the benchmark. My models are saying if there is no value added to the portfolio by buying IT, we simply ignore IT. So point is, when you look at the benchmark and when you look at your portfolio, both of them can be completely different based on the merits of each stock, based on the merits of each sector, and based on the merits of the market cycle. And as I already explained to you all, that we take a holistic approach by combining macros, style, fundamental, valuations, technical, risk, and liquidity analytics while making any investment decision. This whole approach that you're looking at, that is the back end of AQUA. And a little bit more about the great Einstein and the principle of relativity. I think this has been one of the biggest finds that we've done over the last 3 to 4 years. And in today's session, I think the big topic should be accepting a few traditional core principles of investing and challenging many others, right? So one core principle that I would like to challenge in the, from whatever we've heard and known so far about investing is looking at fundamentals in a certain way. So while I acknowledge and accept that fundamentals are very, very important, I challenge the way we look at fundamentals. So every time we look at companies, we say, अच्छा 15% का ROE है, healthy ROE, 15 PE से सस्ता है, looks like a cheap company to me, or 18% growth hai, looks like a healthy growth rate to me. I think we cannot look at markets or stocks in an absolute way. Everything is relative, and I'll give you examples of that. So let's take FMCG and infra, two very, very different sectors. FMCG is very, very capital light. Infra is very capital intensive. So ideally in a capital light business of FMCG, generating an ROE of 15% is a cakewalk because they don't need capital to grow, right? But in infra, they need to keep pumping capital. They need to keep pumping working capital to make sure they can execute these orders. So an infra company who's managing their business efficiently, if they are generating an ROE of 15%, they should be superiorly rewarded as opposed to an FMCG company where the average industry ROE is 25%. So ideally, I would penalize an FMCG company who's generating an ROE of 15%, but reward an infra company who's generating an ROE of 15%. So this is relative. So relative to what? The peers that they are operating with, the past experience of the company and the past history of the company. Let's look at a company which was doing, say, 30% ROE for 5 years in a row. But for the last 2 years, its ROE profile has gone down from 30 to say 15, 20. Now, while 15, 20 on an absolute level is very high, but would we reward a move like this or we would penalize a move like this? Audience, please. Sorry? Exactly, right? We would penalize a move like this. Why? Because based on its history, it is doing less good or it is doing worse off than what it did before. Similarly, based on the broader market growth, you would reward and penalize growth also. To give you an example, when India is in a very, very strong growth phase, most of the industrials, pro-cyclical companies are growing in the 20% plus range. So when corporate India is growing at 20% plus, you don't want to invest in companies that are growing at 8-10% plus, right? So while 8-10% is not a bad level of growth, in this cycle, 8-10% is bad because others are growing at 20. But what happens in recession? When we are hit with a recession, our staples, our IT companies, they are growing at say 6 to 10%. But when others are degrowing, the 6 to 10% also looks very, very attractive. And that is why I think everybody who's been around in the markets for more than 15 years knows that in bear markets, people move to hide behind high quality stocks, defensive sectors like pharma, like IT, like consumer staples. Why is this? Because on a relative basis, their growth is going to be better than the cyclical companies. But in an up cycle, their growth at 8, 10, 12% is not comparable to the cyclical companies which are growing at 18, 20%. So the way we look at fundamentals, the way we look at growth, the way we look at valuation, everything is relative. Relative to what? The past, the peers, and the broader market cycle. And that is the secret or the difference in looking at stocks with a completely different lens. And another thing we do very, very differently here is looking at time horizons in a very different way. And I'll take you all through that. So we've heard multiple people talking about long term, 5 years, 10 years, 15 years to create wealth. But what we believe is that the long term is nothing but an addition of multiple short terms. So can you do well in the long term without doing well in the short term? I don't think so. And a real life example is next year I say have my board exams or my CA exams. And full year I'm going to not study, I'm going to travel, I'm going to party, I'm going to enjoy. And last 1 month I'll wake up and be like, okay, now I need to study because I want to pass this exam. What is the probability that I'm going to pass this exam? I think it's going to be very, very low. As opposed to somebody who studied throughout the year. So similarly, even in investing, you can't expect long-term outperformance without actually outperforming in the short term as well. If you have a health goal of making, I don't know, being very fit or losing weight or whatever, you need to actually put in those hours. You need to work out 100 times. You need to diet for 300 days. You need to do all that, right? That action is a short-term action you need to do consistently, without which you will not achieve your results. So even in investing, we look at markets, we break down markets into much smaller cycles and decide if I outperform on a relative basis, even in the short-term cycles, then over the long term, my wins will add up and I will end up winning. And that is the whole method of designing a strategy for alpha generation, as opposed to just buying stocks and hoping that over a period of 5-10 years they'll go up and at the end of the day I will win. I think performance must be measured in the short to medium term also and over the long term as well. And when we say look at some statistics, right, of AQUA, what we've realized is that all those investors, when we look at our portfolio performance on a monthly basis, around 60 to 65% of the times, AQUA would outperform the benchmark, which means we would get it right. Close to 35-40% of the times, we would go wrong on a monthly basis. On a quarterly basis, the number is 74, but I've just written more than 70 for simplicity. We get it right more than 70% of the times. We get it wrong less than 30% of the times. On a yearly basis, this number increases. So as we go from 1 month to 1 quarter to 1 year to 3 years to 5 years, the percentage of us getting it right keeps increasing in a very linear fashion. Similarly, the amount of times we get it wrong also keeps increasing or decreasing in a linear fashion. So this is the whole concept of short-term wins adding to long-term outperformance, which is very different from anything we've heard traditionally, that only focus on the long term, because long term 5 साल के बाद आपका पैसा बनेगा, अभी कुछ नहीं बनेगा, 5 साल के बाद बनेगा. I don't think investors have that kind of patience in the fast world that we are in today. And we'll also talk a little bit about the key risks that all of us face while managing money, while investing, and how we deal with these risks in AQUA. So we've identified 6 key sources of risk and how we really deal with them. So the first source of risk is fundamental risk, where the company that you're investing in has some serious fundamental weakness which is going to hit your portfolio in the near to medium term. So the way we do it is we have created a fundamental filter of close to 55 plus indicators, which helps us eliminate 100 stocks out of the top 500 in India based on fundamental weakness. So by using elimination, we eliminate stocks which are weak fundamentally. The second risk is liquidity risk. Liquidity risk is very simple. You're basically buying companies which, when you buy them with a large size, you will make the price of that company, and when you sell it, you will break the price of that company. So because of lack of liquidity, your profits will suffer. So how do we deal with it? Again, we use a filter. We have a proprietary liquidity filter where we eliminate another 100 companies from the top 500 which have weakest liquidity in the investment universe. The other risk is systemic asset class risk. This is, I believe, the worst risk which nobody can really ignore or avoid. What happens here is, when there is a global asset class risk, irrespective of which stock, which sector you buy, your asset class is only going to underperform. Which means, right now, if this escalates into a World War III, no equity markets in the world would do well. Irrespective of which stock you are owning, everything will fall. We saw something like this play out during COVID as well, where every stock that anybody owned, whether large cap, mid cap, Reliance, Bajaj Finance, L&T, didn't matter. Everything corrected and fell very sharply. That is what we call systemic asset class risk. How to deal with this risk? Honestly, there is only one way. You either get into cash or you have some gold to hedge your equity correction. There is no other way to deal with this risk. As an equity investor, when everything in the market collapses, the best you can do is try to have some cash and collapse less than the market in a phase like this. But this is a risk you can't avoid. You can only reduce this. The other sources of risk are sector risk and style risk. We'll talk about this. So when we talk about sector risk, what we are essentially saying is that as the world is becoming much faster today than it used to be before, sector rotation is very fast and very dynamic, which means for 2 months, banks will do very well. For another 2 months, metals might do very well. For another 2 months, infra stocks will do very well. But the whole sector rotation is very, very fast. We want a portfolio that changes its sector mix based on the market cycle rather than have a view of say 3 to 4 years on a single sector. And we only are able to do this based on our quantitative models, where we are saying that we will invest in the mediocre stock of the best sector to make more money rather than invest in the best stock of the worst sector. Let's look at this example more closely, guys. When we look at say IT, we have or private banks, right? HDFC, Kotak, TCS, Infosys. 2 years, no returns. Best stocks, absolute gold standard, but didn't deliver any returns for the investor. Why so? Banks had stock-specific risk. IT had a sectoral, global sectoral risk. So I would have been much better off being in a PSU bank bucket, or being in defense stocks, or being in capital goods stocks, right? The simple point here is, if you choose your sector right, as opposed to only your stock right, your chances of improving your returns are significantly higher. And we've substantiated this with data as well. So 73% of your returns improve when you're in the right sector, irrespective of which stock you've selected. And if you are choosing the wrong sector, even if you get into the best stock, the chances of you outperforming are very, very low. So this theory is very, very important of getting your sector call right and being dynamic to switch in and out of sectors. Don't get married to sectors. Get married to a strategy that is able to navigate complexities of the market. Similarly, when we talk about style alignment, I explained to you guys there are 5 different styles and which of them work in which phase of the market. So our idea should be to get in and use the right style to our advantage, use the other style to our advantage in another cycle, rather than being biased or emotional that I can only do value investing or I can only do growth investing. All of that is immaterial. The only investing you need to do and we need to do is investing for generating alpha. That is the only goal of investing. When the market rises, can you rise more? When the market falls, can you fall less? That is the only measure of whether you're a successful investor or no. There is no other measure. And finally, when selecting stocks, right, once we've decided which sectors we want to be in, which style we want to use, how do we select stocks? We select stocks by combining 3 things: fundamentals, valuations, and technicals. Fundamentals basically tell you, based on growth and quality, which companies have superior fundamentals. Superior means not strong. Superior, the word itself is relative. Superior means better than somebody else, relatively better. That is the whole focus. We don't want to find best, we want to find better. Because everybody knows what is best, and best mein there is no edge. All the best stocks are trading at PE of 90, 100, right? So there is very little that you will earn from re-rating in stocks like these. So we want to find relatively better stocks. Similarly, we talk about sound valuations as the second pillar of selecting stocks. Again, sound does not mean cheap. Sound means relatively cheaper, which means I'm able to find stocks that are relatively cheaper compared to their past, compared to their peers, and compared to their relationship with the market. And the relationship with the market is very simple. I think everybody knows, say, PSU banks have always traded at a discount to market, or say a Titan or a DMart or a Unilever or a Nestle have always traded at a premium to the market. That relationship of theirs is fixed with the market, which means if the market is at 19 PE, a Titan is not expensive at 40 PE. Or if a market is at 19 PE, Unilever is not expensive at 40 PE. Because historically, these capital light sectors, these debt-free sectors, these high ROE companies have always traded at a premium to the markets. So we cannot look at 50k PE and call a Titan or a Unilever or a Britannia expensive. That is absolutely rubbish. We have to look at it from a relative lens. And the final thing is, Once you find companies that are relatively better, that are relatively cheaper to actually make money in the next 2 months, 6 months, 1 year, you also need strong technicals for these stocks. You can't be buying stocks which will do well in 3 years. You have to buy stocks that will help you generate alpha in the medium term also. And that is when you can design a strategy for alpha, as opposed to buy and hold and wait for 4 years, 5 years for that stock to perform. So we combine fundamental valuation and technicals. And the final thing we do is risk management, and I'm going to go and discuss this slightly deeply as well, because this is very, very important. But the way we manage risk is we are very dynamic and regular in our time of managing and rebalancing the portfolio. We rebalance the portfolio every 2 months. 30 to 40% of the stocks change. That is the speed at which we review the portfolio. We review our asset allocation every week, which means if we need to create some cash buffers in the portfolio to protect a sharp fall in the market, our models will be running and trying to do this on a weekly basis to understand if we need to create some cash in the portfolio. Sometimes we also manage the beta of the portfolio to make sure that in a bull market, we are a high beta strategy, and in a bear market, we are a low beta strategy. And all of this is only possible because we are doing it quantitatively. To show you guys a glimpse of how our asset allocation is dynamic, this is basically since 2006 till 2023, how AQUA has changed its colors across large cap, mid cap, and small cap across different cycles. So on an average, I've been fairly in the 30-35% mark per asset class, but this is a long-term average. But between that, there have been cycles when this behaves like a large cap fund, or behaves like a small cap fund, or behaves like a mid cap fund. Even when it comes to sectors, I think it's very, very clear that let's look at 2020 and 21. In 2020, everybody knows that healthcare was the best performing sector in India, and our weight to healthcare was very, very high, close to 30%. But as we approach 21 and 22, so for example, in 2022, my weight to healthcare is 0 because of whatever was happening in US, inventory buildup, price erosion, lot of FDA pressures. Healthcare was an underperforming sector, and our models didn't have a low exposure, we had a 0 exposure. And that is how you create alpha. Whenever you have conviction in sectors, in stocks, in style, you allocate heavily to these. Similarly, if we look at IT, so in 2020 and 21, we had significant exposure to IT. But as we move to 2022, IT exposure has gone to 0. So this is just showing you how dynamically we can manage not just asset classes, also sectors and styles. And this is again a representation of portfolio beta. When do you become a high beta fund manager? When do you become a low beta fund manager? All of this is happening on the back end, which even I cannot process so many data points. But I know that because we have programmed so many things inside, there are systematic rules and layers that help us make these decisions. And finally, we can see something like this on the front of style as well. Sometimes use momentum, sometimes tilt to value, sometimes tilt to volatility. Basically, be dynamic across your style approaches. And with that, we can probably look at even the performance of how a strategy like this is performing, right? So since inception, we've launched this fund, say in mid-June, first week July. We've done close to 22% returns here, as opposed to the benchmark at 5.5% in the 3-month period, or 9% since inception period. Across all periods since our launch, we have consistently generated alpha for investors. And as I told you at the beginning itself, the whole focus is not on returns, but on alpha. Even in the month of October, which has been a fairly rough month, so to say AQUA is down 1.2% versus markets are down 4.5%. So even in a down month, we have generated alpha. And the whole focus here is to outperform the markets on either sides. And even when we look at, say, the historical back-tested performance, we can clearly see that whether we look at 1 year or 10 years or 5 years, the alpha is healthy in the range of 8 to 21%. And this is net of costs, fees, everything. And finally, if we look at how every investor will, roughly behave in a phase of investing in a strategy like this, we call it the happiness index. So what does the happiness index tell us? It basically tells us that when your portfolio is absolutely up and relatively up, you're delighted, you're feeling blue, you're most happy. When your portfolio is up, but it is not beating the benchmark, but it is still absolutely positive, you feel green, you're happy but not delighted. But when your portfolio is down, but it is still beating the benchmarks, it is less down, you feel neutral, you feel yellow. And the worst situation is when your portfolio is down and the markets are up. That is the worst feeling that any investor can really go through, right? So what we are seeing here is, if you look at your portfolio on a 1-year basis, you will mostly feel delighted, but you will also experience phases of neutral happiness, some anger, all of that. As you move to 3-year and 5-year basis, you will always be delighted in a strategy that is adaptive. And with that, I would actually like to open the floor for questions, for any discussions that we would like to have. Thank you guys. Yeah. This or this? Back tested or live? Okay, cool.
So my question, please correct me if I'm wrong,
Sure.
but the strategy has gone live from June 23, correct? So ever since June, it has pretty much been a smooth sailing phase for the markets except October. Okay, fair enough. What could be your asset under management in this strategy, if you may, or if you are allowed to disclose?
No, I'm allowed to disclose. So we've launched this in June and we've gathered close to 85 crores in the first 3 months so far. So roughly 85 crores, yeah.
Okay, understood. So fairly 85 crores, then I don't really see a challenge with you having any liquidity risk because you're doing multiple.
Yeah, I don't, till 1,000 crores, no liquidity risk. I think the Indian markets are very broad here today.
Okay, understood. In that case, can you just tell me what is the assumption or what have been your actual transactional costs that you've incurred during these 3 months?
So even in our live performance or even in our back test, we've taken 6% annual transaction costs per annum. And in our live performance, what's happened is, because 85 crore is a very tiny sum in today's markets, and it's divided across 25 stocks on different dates. So we don't buy the whole or sell the whole thing on one day. It's deployed in a staggered manner. So we've not really faced any significant transaction or impact cost yet.
Okay, understood. I'm on the same page with you. In that case, how do you anticipate, if you're saying 6% with weekly churnings?
No, that is in the back test to be conservative. I'm saying in the live, we've not faced any real transaction costs yet. Because in back test, we've assumed minimum 1,000 crore as the cutoff for liquidity risks. That's why.
Right, I understand that. So my question again is coming from, when you reach that mark of 1,000 crores, which would be your peak. So that time when you're saying 6%, that's a significant number, right?
Per annum, but these back-tested returns are net of that 6%. I've already deducted that to be on the conservative side.
Understood.
Okay.
Then I'm good with it.
Okay.
Hi Siddharth.
Hi.
Very insightful discussion.
Thank you.
Siddharth, I want to take this argument at a more industry level based on how we have seen other markets behave from an overall quant-based investing style. So as per your assessment, what is the inflex point in terms of market maturity, be it size, depth, liquidity, where, you know, this asset class is going to deliver its best possible return, you know, the kind of maybe like a 1 lakh crore AUM based on quant-based trading. So something more because the stage of maturity.
See, even in quant, there are multiple types of strategies, right? What you are referring to is a high frequency strategy, which means intraday basis, daily basis, they are trying to churn stocks. We are not doing that. We are not a quant trading fund at all. We have a 2-month cycle where 30% of the stocks get rebalanced. So assume I bought some stock. We've had multiple cases where we bought a stock, it's up 50%, we bring that weight down to 4%. This runs on an equal weight approach because we don't want to take biases in weighting also. As many sources of biases that we have identified, we've tried to create a strategy to eliminate those biases, including weighting. So I think given the nascent stage we are in, I think it's a 35,000 crore odd market in India yet on the mutual fund side. But at least I think we're not even 0.5%. Yeah, the amount of volume that can be absorbed in India purely based on retail, I think that also is very, very high. So I think 10% of the market, so 4-5 lakh crore looks easy to me. 10% of the market, let's assume as a conservative estimate. America is at 35, but 35 includes all high frequency firms as well. So in India, I don't think high frequency is relevant because we don't have that much intraday depth with that volume. 100%, 100%. But as I told you, we eliminate all illiquid stocks based on trading volumes, delivery volumes, free float market cap, etc. So we try to eliminate as many of these risks. So at least for the next 3 to 5 years, I don't see that being a big issue. As many quants come in, I think that's probably a point of debate in 5-7 years. But till then, this asset class is new. This is giving a new approach. So all the pioneers and first movers will obviously cream a lot of this. And as more people start entering a crowded market, then some of these issues will be relevant. Yes, done. Thank you so much. Thank you so much, guys, for being attentive through this session.